Everything starts quietly before it becomes obvious. In this video, we are breaking down 3 overlooked growth stocks that could be setting up for the same kind of explosive multi-year run Nvidia pulled off in 2023. You are going to learn why these businesses matter, what hidden growth engines are starting to turn on, and why patient investors may be getting a rare second chance before Wall Street fully wakes up. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let us start with the first company because this is where the foundation of the entire AI and high-performance computing boom is quietly being rebuilt. The first stock we are talking about today is Micron, ticker symbol MU. Before we talk about numbers, charts, or price targets, you need to understand why Micron actually matters. Micron is not a flashy consumer brand. It does not dominate headlines, but it sits at one of the most critical choke points in modern computing. Memory is not optional. Every AI model, every data center workload, every smartphone, every autonomous system depends on memory to function. Without it, none of the software magic works. Micron is one of the very few companies in the world capable of manufacturing advanced DRAM and NAND memory at scale. This is a business that requires enormous capital investment, decades of process knowledge, and the ability to survive brutal industry cycles. Those barriers are not theoretical, they are why the industry has consolidated down to only a handful of players, and Micron is one of them. What makes Micron especially interesting right now is timing. Memory is a cyclical business, and Micron has just come through one of the worst downturns in its history. Prices collapsed, inventories ballooned, and earnings were crushed. Many investors walked away assuming the story was broken. But that is usually how the best setups begin. The key thing to understand is that Micron did not sit still during the downturn. The company aggressively cut supply, reduced capex, and positioned itself for the next upcycle. At the same time, demand drivers began to change structurally. AI workloads are far more memory-intensive than traditional computing. High-bandwidth memory is becoming a critical bottleneck, and Micron is one of the few suppliers capable of producing it at scale. This is where the Nvidia comparison starts to make sense. Before Nvidia exploded in 2023, most investors viewed it as just another chip company. What they missed was the shift in demand. The same thing is happening with memory. AI models require exponentially more memory capacity and bandwidth than legacy systems. That demand is not cyclical, it is structural. Micron has already begun shipping high-bandwidth memory products designed specifically for AI accelerators and data center workloads. These products carry significantly higher margins than traditional DRAM. They are also capacity-constrained, which gives Micron pricing power it has not had in years. Now let us talk financial context, because this is where the setup becomes compelling. Coming out of the downturn, Micron is positioned for a sharp rebound in revenue and profitability as memory pricing recovers. Management has guided toward improving margins as supply discipline holds and demand ramps. Importantly, this is not just a rebound to old levels. The mix is changing toward higher value products. Free cash flow is expected to inflect as pricing improves. Capital intensity is coming down relative to peak investment years, and the balance sheet remains strong enough to support the transition. This is not a company fighting for survival. This is a company preparing for its next growth phase. In my view, Micron represents a classic quiet compounder setup. It is essential infrastructure. It benefits directly from AI adoption, and it is emerging from a downturn at the exact moment demand dynamics are improving. That is often when the biggest multi-year runs begin. Now before we move on to the second stock, let me quickly share today's sponsor because it fits perfectly with what we are doing here. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move to the second stock, and this one might surprise a lot of people. The second company on this list is Nokia, ticker symbol NOKI. You may be surprised to see Nokia on this list. For many investors, Nokia still feels like a relic of a past tech era, a former mobile phone giant that lost its edge and faded into irrelevance. But that outdated perception is exactly why this opportunity exists today. Nokia is quietly making a comeback, and it is doing so by positioning itself at the intersection of telecommunications, cloud infrastructure, and artificial intelligence. Back in November 2025, Nokia formally announced a strategic pivot that fundamentally reshaped its long-term direction. The company committed to becoming an AI-native wireless infrastructure provider, focusing on building networks that are not just faster, but intelligent by design. This includes deep investments in AI-driven network optimization, automation, and cloud-based architectures across both 5G and future 6G networks. This pivot is not just talk. It is backed by real capital and real partnerships. Nokia secured a $1 billion strategic investment from Nvidia to accelerate the development of AI-native wireless technologies. That investment was a clear signal that Nokia's infrastructure and networking expertise still matters at the highest levels of the technology ecosystem. It also reinforced the idea that future AI workloads are not just about compute, but about how data moves efficiently, securely, and reliably across networks. Today, Nokia is not a handset company at all. It is a global telecommunications infrastructure provider deeply embedded in the networks that power the modern digital world. Its core business revolves around building and maintaining the backbone of global connectivity, including mobile networks, network infrastructure, cloud networking, and increasingly private wireless networks designed for enterprise and industrial use cases. As part of its transformation, Nokia is restructuring the company down to two main operating divisions: network infrastructure and mobile networks. This simplification is intentional. Network infrastructure focuses on IP routing, optical transport, fixed networks, and cloud-based platforms. These are the systems that enable high-speed data movement, data center interconnects, and cloud service scalability. Mobile networks focuses on 5G today and 6G tomorrow, with a strong emphasis on AI-driven automation and software-defined networking. Both divisions are positioned to play critical roles in the future of AI data workloads and cloud services. AI does not live in isolation inside data centers. It relies on low-latency, high-reliability networks to move massive volumes of data between devices, edge systems, and centralized compute. Nokia's leadership believes that AI and cloud customers represent its greatest opportunities for meaningful growth over the next decade. What makes Nokia especially interesting right now is how quietly it is transforming its business model. The company has been shifting away from lower-margin, commoditized hardware toward higher-margin software, services, and licensing. It has streamlined operations, exited underperforming segments, and focused investment on areas where it has genuine technical differentiation and long-term relevance. One of Nokia's most underappreciated advantages is its intellectual property portfolio. The company holds tens of thousands of patents related to wireless standards, including core technologies that underpin 4G, 5G, and future 6G networks. This patent portfolio generates recurring licensing revenue that is relatively stable and high margin. That revenue provides a dependable cash flow base that supports continued investment in AI-driven networking innovation. From a growth driver perspective, private wireless networks are particularly important. Enterprises are increasingly deploying their own secure, high-performance wireless networks for factories, ports, logistics hubs, airports, and large campuses. These environments require ultra-reliable connectivity, low latency, and strong security. Nokia is one of the few companies globally with the scale, credibility, and technical expertise to deliver these solutions end-to-end. Financially, Nokia is in a much stronger position than most people assume. The company generates consistent free cash flow, maintains a solid balance sheet, and continues to return capital to shareholders. Valuation remains compressed largely because the market still associates Nokia with its past, rather than its current and future business mix. I do not see Nokia as a stock that will triple overnight. Instead, I see a business with improving margins, clearer strategic focus, and real optionality if AI-driven networking and enterprise cloud connectivity accelerate faster than expected. In that sense, it resembles early-stage Nvidia before AI became a household investing theme. The groundwork is being laid quietly, and the payoff may only become obvious once the market fully catches on. Now let us move to the third and final stock on this list. And in many ways, this is the one that best fits the idea of a quiet compounder hiding in plain sight. The third company is Broadcom, ticker symbol AVGO. Broadcom is not a story stock, it is not a concept stock, it is not a company built on promises about what might happen someday. Broadcom is a cash-generating machine that sits at the center of the most important technology infrastructure in the world. If Micron represents the memory foundation of modern computing and Nokia represents the connective tissue, Broadcom represents the brains behind how data actually moves, scales, and monetizes. Before talking about numbers, it is critical to understand why Broadcom matters. Broadcom designs and supplies semiconductors that are essential to networking, broadband storage, and data center infrastructure. These chips are deeply embedded into systems that are extremely difficult to replace. Once Broadcom silicon is designed into a platform, it often stays there for many years. That design win stickiness is one of Broadcom's biggest moats. Customers are not switching these components lightly. The cost, complexity, and risk of redesigning entire systems around new silicon creates a natural barrier to competition that results in long product life cycles, predictable demand, and pricing power. But Broadcom is not just a semiconductor company anymore. Over the last several years, it has deliberately transformed itself into a diversified infrastructure technology company with a growing software segment. This is where many investors still underestimate the business. Broadcom's software portfolio focuses on enterprise infrastructure software that is deeply embedded in customer operations. These are mission-critical tools that companies rely on to run networks, manage workloads, and secure data. Software revenue is recurring, high-margin, and far less cyclical than hardware. That combination stabilizes Broadcom's earnings and enhances long-term compounding. From a growth driver standpoint, Broadcom sits directly in the path of several durable trends. Data center traffic continues to grow exponentially. AI workloads require faster networking, more bandwidth, and lower latency. Cloud providers and enterprises alike are investing heavily in infrastructure upgrades to support this demand. Broadcom's networking chips are designed to handle exactly these challenges. As AI models scale, data movement becomes just as important as raw compute. Bottlenecks shift from processing to networking. Broadcom benefits directly from this shift because it supplies the silicon that enables high-speed data transfer within and between data centers. This is one of the reasons Broadcom feels like a quiet Nvidia-style setup. Nvidia exploded when investors realized GPUs were the bottleneck in AI. Broadcom stands to benefit as networking becomes the next bottleneck. That realization is still forming in the market. Now let us talk financial context. Broadcom generates enormous free cash flow. This is a company that consistently converts a large percentage of revenue into cash. That cash is used strategically to pay dividends, reduce debt, and reinvest in high-return opportunities. The dividend is an important part of the story. Broadcom has a track record of increasing its dividend aggressively over time. That reflects confidence in long-term cash generation. It also attracts a different class of investor, which can stabilize the stock during periods of volatility. Valuation-wise, Broadcom is not cheap in the traditional sense, but it is reasonable when viewed through the lens of quality and durability. Investors are paying for a business with entrenched positions, recurring revenue, and exposure to long-term secular growth drivers. In my opinion, Broadcom is the type of stock that does not need hype to perform. It compounds steadily, occasionally accelerates when new demand drivers emerge, and rewards patience. If AI networking demand ramps faster than expected, Broadcom could see upside surprises that the market has not fully priced in yet. Now let us zoom out and connect the dots across all three stocks we discussed today. Micron, Nokia, and Broadcom each occupy a different layer of the same technological stack: memory, connectivity, and infrastructure silicon. None of these companies rely on consumer hype cycles. None of them are dependent on short-term trends. They are embedded in systems that power the digital economy. What makes them interesting right now is timing. Each one is at an inflection point where long-term demand drivers are strengthening, while market perception remains cautious or outdated. That gap between reality and perception is where opportunity lives. Micron is emerging from a brutal downturn just as AI-driven memory demand accelerates. Nokia is transforming into a leaner, higher-margin infrastructure provider as private networks expand. Broadcom is positioned to benefit from the next phase of AI infrastructure, where networking becomes critical. These are not get-rich-quick stocks. They are not built for traders chasing momentum. They are built for investors who understand compounding, moats, and long-term relevance. That is exactly why they remind me of Nvidia, before the crowd fully caught on. Now I want to hear from you. Which of these three businesses do you think has the strongest long-term competitive advantage, and which one do you believe is most likely to surprise the market over the next 3 to 5 years? Let me know your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.